you ready to increase your after-tax income and unlock wealth in 30 minutes or less? If so, you're in the right place. I'm Billy Amberg, founder of Bloomwood, and today we are going to explore a case study that affects you. Yes, you. Whether you are just starting out and building wealth or whether you are a gazillionaire. So listen up. So here's the situation. The investment, financial advisor, wealth management industry, call it whatever you want to call it, has spent massive amounts of marketing dollars to convince you that paying 1% of your portfolio per year to manage your money is worth it. For those of you listening who have financial advisors or planners that provide massive value with tax planning, estate planning, and actually provide you with a financial plan that gives you peace of mind that you'll achieve your financial goals, 1% is an acceptable fee to pay. For those of you listening that have a complex trust or an entity with really unique investment needs, 1% is also an acceptable fee to pay. However, for those of you listening who have a financial advisor that basically just manages your money, answers questions reactively, and doesn't really do anything proactively like tax planning, financial planning, estate planning, maybe they proactively set up meetings to go over investments, but that doesn't really count, you're being ripped off. Now, that's a bold claim. So let me show you objectively, or as close to objective as I can possibly get, why you should listen to this seriously and take action. So let's pause for a bit and just acknowledge how people tend to feel when they hear this information and realize that they may have been missing out on greener pastures. So frustration, perhaps anxiety, all fine. Let's push forward and let's see how we can alleviate those feelings and get more value for your money. So to understand why paying 1% for just investment management and reactive, not proactive advice is unacceptable for the vast majority of people, we have to understand a few things. Number one is the best way to invest money, and that's the 3 buckets approach. So this way of investing money applies not just to individuals of all shapes and sizes from just starting out to ultra high net worth. This is also how large pension plans and retirement systems manage money. So here's how it works. You have 3 buckets that you fill up that are related to different obligations. So you first have a cash reserve bucket, which is either for opportunities, maybe buying a piece of real estate, but mostly it's for, hey, if something happened to you, and you can't earn, we need to have 6 to 12 months of your lifestyle covered so that the bank doesn't come calling and repo the house because you can't pay your mortgage because you didn't have the cash reserves. Then once that's filled up, we go to a bucket that may or may not be filled up for every person, but that is, do you need any income to support a lifestyle? Typically, if you're retired. So you would put bonds or fixed income, as it's referred to in the industry, types of investments in that bucket because we want a legal obligation for that amount to come in that satisfies your lifestyle need. We don't really want to leave that up to a stock paying a dividend because a company that issues that stock can just say at whim, based on whatever the management team decides, okay, we don't want to do a dividend anymore. It happens. So you don't want to mess with the rent money, quote unquote. That's what this bucket is for. Then everything else, and I mean everything else, goes into the long-term growth bucket, which is, we've all heard, or I hope we've heard Warren Buffett say, it would be better probably for most people if there was only one opportunity to buy or sell every year. This is designed to, you put it in long-term growth investments, typically equity or stocks, and you let it go. And as you approach retirement, or as you approach a cash flow need, we take a proactive look at saying, hey, okay, 10,000 a month is, let's say, John's retirement goal. Well, if John has hit that and is going to be able to fill that bucket to get 10,000 a month, that fixed income bucket, it's our job to tell him that and say, hey, do we want to start taking less risk, or do we want to continue to let it ride and figure out what's right for John? So the second thing we need to understand is that risk tolerance, which you may be familiar with depending on your relationship with an advisor. If you've gone to one of these platforms like a Vanguard, it's asked you questions about how long you've owned stocks or bonds, what you might do in certain market situations. So that risk tolerance matters and doesn't matter at the same time. And so here's what I mean. Risk tolerance matters for getting to know you as a client. It helps prevent emotional decision making, and it helps me as the advisor figure out how you may react to certain things that happen in the market and in your account. Where it doesn't necessarily matter is goals-based financial planning. So I'll give you an example. Young guy out of college, has student loans, has a degree in art. It wants to be a museum curator. But he also is scared of the market and doesn't want to lose money. Now, I could just say, okay, that's your risk tolerance. We're just going to invest you in US Treasuries. But the conversation that really needs to happen is, Mr. Client, you're in a field that's likely not going to provide you with a whole lot of financial resources flat out unless you get some sort of market return akin to an S&P 500, like 7-8% per year rather than 3 or 4% for US Treasuries. You will not ever be able to retire. So having the conversation with someone about, well, here's kind of the reality of how this is going to work if we just base this on what you're comfortable with, versus coaching them through the fact that this is the long-term growth bucket and things go up and down, but they generally, and they always have, gone up and to the right over time. If you look at a graph of the S&P 500, for instance, it's hard for most people, if you take away the date on whatever axis the date is on, typically the bottom axis, it's hard for people to point out 2008 because it looks so small now compared to what it felt like at that point. So risk tolerance matters, but it also doesn't matter if you follow me. So let's keep that in mind. Now, I'm going to share my screen to show you the next part, which is the reality of what should be in that long-term growth bucket. And then the dirty secret of the financial advisor industry, which is managing money is the easiest part of the job. So what you see here is in yellow, where my cursor is now, this is the S&P 500. Now, when we say that long-term growth bucket, this is going to be set it and forget it. Typically, an index fund is best. Now, what we have up here, which I'm pointing my cursor on now, is the NASDAQ, or the technology index. Now, as you can see, it has significantly outperformed the S&P 500. And in my opinion, the S&P 500 is no longer the benchmark. The technology index is the benchmark, or you replace that with some global benchmark that rewards innovation wherever it takes place, regardless of the United States, of whether it's in the US or not. So the fifth thing that we need to understand is trying to beat an index or beat a benchmark like this by picking stocks and timing the market is foolish for a couple of reasons. So, number one, an advisor has, ideally, if they have a successful practice, they have multiple clients. All of those clients are different. So if we think about this, the idea that that an advisor may have be trying to go for a different benchmark for multiple clients, the idea that that advisor can beat even one of those benchmarks is pretty far-fetched when you consider that even professional fund managers that don't have clients, they just manage a single strategy fund, can't even beat this yellow line, which is the S&P 500. And there are an insanely small number of firms that can beat this top chart. And if an advisor is trying to shoot for outperformance, they have to outsource it to one of these fund managers to do it. So then what are you paying them for? Because you also have access to these things. You just have to look. The idea that you have special access because you're at a certain firm is just not true at all. There is an exception for getting individual stocks that are privately held, like if like SpaceX or something like that. That's differentiated. So then what you have to realize is that the only funds that are really outperforming nowadays are quantitative hedge funds like D.E. Shaw and Citadel and Two Sigma. And D.E. Shaw charges 4% asset under management fee and 40% of profits. That's pretty steep. And they have performed extremely well, but you've got to have a lot of money to invest with them. Now, I'm going to show you the next thing that you need to understand why 1% just for investment management is too much. Good old Vanguard, which I'm sure many of you have heard of. So you get a certified financial planner at these different levels, but I mean, even for just 0.30%, which is more than a third cheaper than you're currently paying, you get a certified financial planner to do exactly the same thing that's going on. And oh, by the way, Vanguard uses the actual index funds, so you won't be underperforming just the general market anyway. And by the way, even without an advisor, you can buy these funds, like this fund, or either the S&P 500 or this technology index. It essentially costs nothing to own. It's 0.05% asset under management fee to perform, frankly, miles better, and always will perform miles better than any financial advisor that fancies himself an active manager. So then number 8 is, can you actually point to tangible value that's been delivered from an advisor? Because if we're pointing to investment returns as value, then we have to separate anything that's above the benchmark return, because as we've just said, you can own this for nothing. You basically don't have to pay anyone anything. to get either of these benchmark returns. It does not require an advisor. So when most people go through that exercise, they find that it's actually quite the opposite, that they're actually being harmed by active management because they're either slightly or significantly underperforming this and paying a privilege of 1% to have that underperformance. So paying 1% for the privilege of underperforming something that is essentially free. So, as a recap, if we're paying 1% for assets under management, it better come with some serious planning and some serious peace of mind. Ideally, it also comes with real tangible value, like what we deliver here at Bloomwood, that can have a huge impact on your life, whether that be saving a huge amount in taxes, whether that be ensuring that you have tax planning done for a potentially taxable estate, making sure that wills and trusts are in order. So really the call to action here is for anyone that feels they're not getting a fair shake on pricing, or that they're just not getting great value for money given everything that I've said in this podcast. Just reach out to us. Our analysis is always free. If there's massive value that we can deliver to you above and beyond just managing investments, then we talk about becoming a client. Otherwise, our analysis is free and you can use it with whoever you want: CPA, estate planner, other advisor. That's our gift to you. So let us know. See you on the next one. If you found this valuable or applicable, please click the Contact Us button below to answer a few simple questions and get scheduled with a Bloomwood advisor to discuss your unique situation. The information covered and posted represent the views and opinions of the guests and does not necessarily represent the views of Bloomwood. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for financial, legal, or tax advice. Always seek the advice of your financial advisor or other qualified professional with any questions you may have. Bloomwood is a Georgia and North Carolina registered investment advisor with its principal place of business in Atlanta, Georgia. Bloomwood and its representatives are in compliance with FINRA and state regulation in the states where Bloomwood maintains clients. Bloomwood may only transact business in those states in which it is registered to do so or is exempt from registration. Past performance is no guarantee of future results. Tax relief varies based on client circumstances, and all clients do not achieve the same result. This content does not constitute tax advice, legal advice, or financial advice, and does not create an advisor-client relationship between Bloomwood and the listener. This case study is designed to give you an overview of the impact that proper tax and financial planning can have on your financial life. The figures in this case study are not calculated to the exact penny and are designed to facilitate a conversation. Thank you.